Welcome to Archiversity online lectures. In this lecture, I am going to explain you how to calculate, analyze and interpret payables turnover ratio. For this purpose, I choose annual reports of two companies. One is fertilizers manufacturer in India and the second one is real estate and construction company in India. Using the statement of profit and loss account and balance sheet of these two companies, I'll explain you how to calculate, analyze and interpret payables turnover ratio. Payables turnover ratio is also called as creditors turnover ratio. In your textbooks, you will find creditors turnover ratio instead of a payables turnover ratio. However, in my lectures, I use payables turnover ratio because the contemporary balance sheets does not have any item as a creditors. So it is a trade payables which is shown in a balance sheet. So that is the reason why I'm using a payables turnover ratio instead of a creditors turnover ratio. And how is that you need to calculate payables turnover ratio is this equals to net credit purchases upon average creditors. So this is one equation, and the second one is net credit purchases upon creditors. That is the closing creditors which is shown in a balance sheet. However, in a balance sheet, neither you find net credit purchases nor creditors. So in the balance sheets of a company, you will find raw materials consumed, and this item you will find in a statement of a profit and loss account. And instead of creditors, you will find trade payables. So trade payables you will find in under the head current liabilities and in balance sheet. So that is the reason why I thought it is more appropriate to use the payables turnover ratio. In that case, we'll have your raw materials consumed upon trade payables. So we'll calculate the payables turnover ratio using two companies data. This is one is statement of a profit and loss account. This is for Coromandel fertilizers. So all the amounts are in rupees lakhs, and is for the two financial years 2019 and 2020. So here from expenses you will find that the cost of materials consumed. So this is your credit purchase, and here you will not be knowing whether these materials which are purchased by the company are on the basis of a cash or a credit. So that information is not available. But what is that we do is we make an assumption that of the all the cost of materials consumed are purchased on credit basis. So here you have a materials consumed for both the financial years. Then comes your payables. So payables you will find in a balance sheet under the head current liabilities. Here you have a current liabilities here, and you will find trade payables. So trade payables are classified into two. One is total outstanding dues to micro enterprises and small enterprises, then total outstanding dues of creditors other than micro enterprises. So these two items you need to consider. So these are your trade payables, and you can see that details of trade payables in note 23, and there is no mention of raw materials consumed because the note is not given. So directly we make assumption that all the raw material purchased are on the basis of a credit. So just we make an observation of a trade payables. So here acceptance, trade payables, other acceptances. Then here is the total amount of a trade payables. All right. Now we'll calculate this for the two financial years. That is for 2019 and 2020. Our net credit purchases are 7,95,965, and here 7,50,174. This upon your payables. So we'll add these two and directly take the value 1261 plus 375,006. So 376,267, 376,267. This is for 2019, and for 2020 this is 943 plus 333,774. So 334,717. 334,717. So our turnover ratio, payables turnover ratio is 795,965 upon 376,267. So 2 times, and 750,174 upon 334,717, 2.24 times. 2.24 times. Using these values, we will calculate average payment period, that is how many days of credit flexibility or time lag the company is getting. For this, you need to divide 365 by your payables turnover ratio. So for 2019, this is 365 upon 2, and for 2020, again this is 365 upon 2.24. more or less we may get the same time period. So 365 upon 2, 182 days, and 365 upon 2.24, 162 days. So here 182 days and 162 days, or we can say 163 days. So that means here, when you are looking at the payables turnover ratio, the lower the payables turnover ratio is, the better for the company. In the sense, the company is getting a much time to make a payment to its creditors. So here it is taking 182 days of a time, and here it is taking 163 days of a time. Now this, in the sense, the company has a flexibility or a time lag of making a payment to its suppliers 182 days. Now this should not be wrongly interpreted, in the sense, if a company is taking of too many days to make a payment, maybe you may think that this indicates a poor financial position of a company. But if you look at the cash position of this company and look at the current assets, so here the company has got cash balances equivalent to, so here you have a cash and cash equivalents 3,236 and 11,093 million, and bank balance is also there. So the company is having a sufficient cash reserves. Even then, there is a delay in a payment of trade payables. So that means the suppliers are waiting. The suppliers are waiting for the company to make a payment. So in this case, this the high average payment period will give a liquidity and will give a flexibility to the company in terms of a working capital requirement, because while calculating the cash conversion cycle, so the average collection period is deducted from your total conversion cycle. So in that sense, the company requires less working capital, and this acts as a kind of a short-term financing source for the company. So this is a case of a Coromandel, and we look at the another one. This is a Sobha Limited, and here we have a statement of profit and loss account, again for the same 2 years, 2019 and 2020. All these amounts are in rupees million, and we are interested in our expenses. So here you will not find one direct expense, that is you have a land, then you have a cost of raw materials and cost of project materials. So these three need to be considered. That is the reason why I chose this company also, because in a manufacturing company, cost of raw material is given under a one head, whereas in case of real estate or construction company, this has got a two. One is they purchase a land, they construct buildings, and then they sell. So that is the reason why they have a three different expenses headings, heads. One is a land purchase cost, second is cost of raw materials, and third one is a project materials. So you will need to consider all these three as net credit purchases. This is one. And next is that your payables, that is you will find in current liabilities. Again, here you have a two payables, outstanding dues to micro enterprises and others. So here there is no amount for micro enterprises, so we'll consider only one item here. All right, that is other enterprises, not a micro and a small enterprises. Using these two, we calculate a payables turnover ratio and average payment period of Sobha Realtors for 2019 and 2020. So financial year 2019 and 2020. So we have to summarize these three to get credit purchases. 464.46 plus 2755.69 plus 10856.44. So 14077 we can take 14077, and then 4257.15 plus 3001.53 plus 7296.54. So 14555. So these are your net credit purchases, this upon your trade payables. So trade payables, here we have trade payables under current liabilities 11 to 39, 11 to 39, then 9597, 9597. So your payables turnover ratio, this equals to 14077 upon 11 to 39, 1.25, 1525 times, and 14555 upon 9597, 1.51, 1.51 times. So there is a decrease in turnover ratio. We'll see that the average payment period. So this is 365 upon payables turnover ratio. So for 2019 and for 2020. So here 365 upon 1.25, 292 days, 292 days, and here slightly less, that is 365 upon 1.51, 241 days, 241 days. So for Sobha Realtors, so here the company is Sobha Limited, which is into real estate. So for them the trade payables ratio, that is they are taking around 292 days to make a payment. Now again you need to check with this with your balance sheet and cash flows, whether they have enough cash or not. Now if you look at the receivables, they have a cash of 567 and 164, then bank balances, then other financial assets. But if you observe here, they have when comparing with the trade payables, so the trade payables are around 9,596 million and 11,239 million, whereas their cash and cash equivalents are hardly 1,000 million. So payables are very high. So this high payables and the company's ability to not make a payment of taking a time of 292 days and 241 days indicates that the company may be having some kind of a cash constraint. Even if we need to look at the investments also, investments in terms of investments, yeah, there are investments of 3,000 here and 4,000 here. Even if you consider investments also, that is investments in non-current investments, the amount is very minimal. So this indicates that on the other side the inventories are very high for this company. So this indicates that there is some kind of a cash constraint in this case of a Sobha Limited, because of which there is a delay in a payment. That is one. Or the second, we can say that as this is a construction company and they purchase the land, so immediately they will not make a payment for the land. Land is purchased on making first, initially they make an advance payment, and then they verify the documents, then they enter into a contract, then the registration. So in that process it takes time for the company to make the payment. That may be another reason for high payables. So if the company is having enough cash and delaying its payment, then it is advantage for the company. If this delay of 182 days of a time lag for making a payables is because of a cash constraint mean, then the company is financially facing some problem. So here you can observe the trade payables, land cost, there is amount 200 million is due, and similarly due to creditors, other creditors, there is a due. So these as the company says that these trade payables are non-interest bearing, as this is a non-interest bearing payables, and which has to be paid in a 30 to 60 days. Actually the terms of contract is to pay within a 30 to 60 days, but the company is not able to make the payment in 30 to 60 days. There is a delay of 182 days, a time lag of 182 days. So you need to do a more in-depth analysis on this to know this delay is because of a cash constraint, or this delay is because of a company taking advantage of their suppliers. Then only you would be able to come to a conclusion. Just by looking at a payables turnover ratio, you cannot conclude, you cannot jump into concluding that the financial capacity of the company is poor. So this is how you need to calculate the payables turnover ratio, and each company's payable turnover ratios will vary. In case of a Coromandel fertilizers, we saw that the turnover is 182 days, and here in this case the company is sitting on abundant of a cash. Even then there is a delay in a payments. So this is because of the company treating trade payables as a source for financing its working capital. And in case of Sobha Limited, here the delay is very high, that is 292 days and 241 days, and this is not supported with the abundant cash resources in the company. That means the company is facing some kind of a cash issues, and it requires more of a working capital. So that you can also find out from the short-term loans that the company borrowed. If you look at the loans that the company borrowed, so you can see that the borrowings are high here. So these short-term borrowings maybe the company may be utilizing for its what I mean to say is working capital requirements. Even if you look at the current borrowings also, here also there is a huge current borrowings. So that means the company is in requirement of a working capital, and because of which there is a delay in making a payments to its suppliers. So this is clearly visible in case of a Sobha Limited. So while making an investment decisions, you need to pay attention towards this factor. This is how you need to calculate, analyze and interpret payables turnover ratio of a companies, and this payables turnover ratio vary from one company to the other company, and it also differs from one industry to the another industry. Thank you very much for listening to the lecture.